Welcome to This Week in Money. I'm Phil Mackesy. Today, Rick Rule talks value, Mike Swanson on gold stocks and fear, and Ben Jones on real estate. We begin with Rick Rule right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Rick Rule specializes in natural resources. He's founder of Global Resource Investments, a member of the Sprott Group of companies, and he's online at SprottGlobal.com. He's coming to us today from Carlsbad, California. Rick, it's good to have you back on This Week in Money.
Always a pleasure to be on your show.
Last time you were on 9 months ago, we talked about value investing. That is where you buy a company at a discount to its intrinsic value. In the resource sector, where value is harder to determine, that's where you try to buy, as I remember, existing assets at a discount. And I got to ask Rick the dumb question of the week here. What's the difference?
Well, there are several different techniques for value investing in resources. On your show previously, we were talking about cash boxes. That's a euphemism for companies that are selling at discounts to net working capital. In markets like this, where particularly institutional investors are deserting the sector en masse, you often find companies where the market cap is less than the cash in the company. And if the management team that's employing the cash is fairly prudent, buying these cash boxes for less than cash is often a good technique. If someone came up to you on House Street and said, would you take a dollar bill for those 2 quarters that you have? You know, the correct answer is yes, and buying cash at a discount is a good thing. There are more sophisticated forms of value investing that are, of course, also wonderful things to do in markets like this. One of the things that I've noticed as we speak is that development stage companies in the mining business are selling at the greatest discounts to the values suggested by their preliminary economic assessment that I've ever seen in the 30 years that I've been in this business. You have this boring period that people describe when the mine is being financed pre-construction between the preliminary economic assessment and the bankable feasibility study. The bankable feasibility study being the document that bankers and competitors use for valuation purposes. The preliminary economic assessment is just what it suggests, a much earlier document. But it's still the best third-party indication of value that exists. And as I say, the discounts to PEA that we're seeing in the market right now are the greatest that I've seen in my 35 years in the business. So certainly one form of value investing, albeit more sophisticated than buying cash at a discount, would be to buy high-quality projects that have been third-party, subject to third-party valuations at big discounts to the suggested net asset value.
Rick Rule is our guest. Rick, all last year we heard talk about gold heading for 2,000, nearly made it. Lately, it seems stuck in that 1,650, 1,700 range. What is behind the recent weakness in gold? What do you see?
Well, if I actually knew, I'd be God.
Yes.
All I can do is surmise. And what I surmise is the incredible amounts of official sector liquidity that have been pumped into markets in the economy by the Europeans, by the Americans, by the Chinese, have brought complacency to the market. Gold was trading higher, I think, as catastrophe insurance, and people are less concerned about catastrophe. It's my own personal belief, but it's just a belief, not a fact, that all of the liquidity that's been pumped into the system is going to begin to cause more obvious inflation. You know, scarcity determines value, and certainly these fiat currencies are anything but scarce. And one would expect that all of this liquidity will find its way into pricing, and hence gold will resume its upward march. I also personally don't believe that any of the sets of circumstances that were conditions precedent to the 2008 financial crisis have passed, with the exception of official sector liquidity. And if you agree with me that none of the conditions precedent have passed, it would suggest that there is a possibility, at least, that some form of anomalous black swan kicked off another financial event. And certainly gold would react well to that financial event. I guess the bottom line, from my point of view, is that gold's advance has been sidelined as opposed to derailed. Further to that, of course, the older listeners that you have will probably recall in the 1970s gold bull market when gold ran from $30 an ounce to $850 an ounce. During the course of that 10 or 11 year advance, gold probably had 20 declines of greater than 10%, but the granddaddy of those declines was the 1975 decline, where gold fell from a little above $200 an ounce to $100 an ounce. So you had a 50% cyclical decline in a secular bull market. The events that you've seen with the gold price softening, and in fact not reaching some of the pundits' suggested prices for this period of time, has nothing to do with the fact that we are not in a gold bull market. I think the gold bull market is very much intact.
Rick, the World Gold Council first quarter report just came out yesterday. One of the surprising things in the report, to me at least, they're saying that gold has not had a significant relationship with equities. They sometimes move in the same direction, but they're saying it's usually other factors like the U.S. dollar. What is your take on that?
I agree with that. I think that gold has had a sort of a unique role in the economy for a long time. I think that gold it's of course an asset class, but what I think is unique about it is that it is a form of payment that is simultaneously an asset. If somebody gives you a dollar bill, it has no value in and of itself. It represents a claim on an asset from somebody else. In other words, it's a promise to pay. Gold is, in fact, payment. And so the stock market moves on perceptions of future income streams, earnings and dividends. Gold moves, first of all, as a consequence of the fact that it's a reliable store of value, but it has also, for many, many, many centuries, in fact, been valued as a form of catastrophe insurance. And it would make sense that given the motivations that one would have for owning gold relative to the motivations that one would have for owning stocks, that they would move in separate directions. You, of course, have completely unsophisticated buyers who, when asked why they buy stocks or why they buy gold, simply say, quote, to make money. But those types of people with that sort of simple attitude are normally consigned to investment failure.
Rick, let's talk about the price of gold for a second. Gold is up around about 10% since we last talked in July. But the disconnect between the gold and the gold miners seems to be growing. The GDX, the senior miners, off 15% since then, and the juniors, GDXJ, off 34%. Why the disconnect, and why is it more pronounced with the juniors?
That's a great question, and I think there are several factors for it. So we'll talk about the factors, and we'll talk about why I think the stocks, at least some of the stocks, are ready to move higher. In the first instance, if you look back 5 years ago, the gold stocks themselves greatly outperformed gold. And so one of the things that happened was simply that the stocks outperformed so much that they needed, if you will, a rest. The second thing that happened was the proliferation, of equity-like instruments that were backed by gold, things like the Sprott Physical Gold Trust, the Sprott Physical Silver Trust, and of course the metals ETFs, which made it easier for stock and bond investors, people with brokerage accounts and retirement accounts, to purchase instruments that represented physical gold. 10 years ago, to buy physical gold, you would have had to go down to the bullion shop, buy some bullion, and either bury it in your backyard or arrange for a safe deposit box and insurance. It's much more convenient for people to own gold now, and they do own gold. The third factor for the gold stocks' relative underperformance relative to gold was the disgusting underperformance of the gold companies as companies in the last 10 years. One would have expected, with the gold price increasing from $250 an ounce to well above $1,000 an ounce, that the producers' cash flows would have gone absolutely spectacularly crazy in the last decade. But for most of the decade, they didn't. In fact, the companies continued to issue equity, diluting people's holdings in the gold and the gold mining operations that the companies had. And so part of the underperformance of the gold equities beginning 2 years ago was investors' disgust with the performance of the companies. And I think the fifth factor was that beginning 5 or 6 years ago, many, many new speculators had their maiden experience with the junior gold sector, didn't understand how the junior gold sector worked, and experience spectacular losses. One of the things that you will note being in Vancouver with regards to the junior gold sector is that although share prices didn't increase, market caps in the sector market cap increased because of the incredible issuance of equity by the junior sector to raise capital. There was no amount of demand that House Street couldn't supply simply by cranking up the printing press.
Mm-hmm.
You know, the gold investors talk about central bank inflation, but the federal government is never as good as the private sector at anything, including counterfeiting. They printed more phony share certificates than the government could print phony dollars. What's interesting to me now is that if you look at each of the factors that led to the gold stocks to underperform, I think we're at an inflection point the other way. In the first instance, the gold stocks' overperformance relative to gold has obviously ended, so gold stocks are relatively more attractive to gold than they were 2 years ago. The attractiveness of the ETFs, then, the gold substitutes for gold stocks, are less attractive. With regards to corporate performance, the most spectacular thing I've seen in the last 6 quarters has been the incredible ability of the senior gold companies to finally generate cash. If you look on these income statements and you strip away all the accounting gobbledygook for tax purposes, what you see is cash at beginning of period and cash at the end of the period. And you will see that the senior companies and even some of the junior companies are beginning to pile up massive amounts of cash. And this is very important. It enables these companies to grow organically without diluting shareholders, and it enables them to return capital to shareholders in the form of dividends and share buybacks, which I think will have an impact on the market. And, of course, the very low equity prices that we're seeing now in and of themselves are beginning to constrain the junior sector from the profligate issuance of stock that we saw in 2010. Now, I need to caution your listeners that if you look at the length and breadth of the junior market, you need to understand that fully 80% of the companies that populate the TSX Venture Exchange with regards to mining are absolutely valueless. Mm-hmm. And I'm not trying to say that the whole sector will go up, because I don't think the whole sector can go up. But I think that you're going to see truly spectacular performance from, as traditionally occurs, a small number of companies on the exchange. And the good news is that unsophisticated retail investors and unsophisticated institutional investors bought the sector with abandon in 2009, 2010, and they have sold the sector with abandon in 2011 and 2012. They have sold the good ones with the bad ones. So I see a pretty good opportunity this year and next year, particularly for sophisticated private placement investors to participate in the ongoing capitalization of the sector going forward.
We're talking to Rick Rule from Global Resource Investments here on This Week in Money. And Rick, I'm just trying to wrap my head around this line from the latest market commentary. This is just a stunning number. The junior market is always overvalued. And you're saying if we were to merge every gold junior out there into one company, it'd lose between $2 and $8 billion a year.
We tease ourselves by saying that the junior industry is more efficient at exploration than the majors. That's idiotic. The general and administrative expense that we have, and that's not all things like salaries in office. A lot of it is things like Sarbanes-Oxley listing expenses. Mm-hmm. The sector is, in fact, enormously inefficient. And if you layer on top of that malcreants and miscreants, that is lazy managers and corrupt managers, it's a very, very, very inefficient way to explore. The truth is that the performance that's generated by 5% of the issuers fires up the greed and larceny of a great number of speculators who pile into the sector periodically, completely unwittingly. But it's very true. If you merge all of the juniors in the world into one company, Junior Explorco, and you looked at the money that they spent on exploration and general and administrative expenditures, and you subtracted from that the money that they generated by way of, takeovers or mines being built, value created, the sector would lose somewhere between $2 billion and $8 billion a year. The point of all this is to say you don't buy the sector, because if you simply buy the sector, if you employ a scattergun approach to accumulating a portfolio of businesses that loses between $2 and $8 billion a year, you will surely go broke. You will surely go broke. What you need to do is do a lot of work, focus on stock selection, and in particular, you need to buy markets during down times, not good times. This sector is so volatile, and there's nothing wrong with volatility if you're prepared to use it. Just don't allow yourself to be used by it.
Rick Rule is founder of Global Resource Investments, a member of the Sprott Group of Companies. He is online at sprottglobal.com. Rick, as always, thanks for taking the time to talk to us.
Always a pleasure.
Coming up, Mike Swanson on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Mike Swanson is founder and chief editor of Wall Street Window, and Mike is online at wallstreetwindow.com. Mike, welcome back to This Week in Money.
Oh, thanks for having me.
Hey, we talked to you last December, and just recently, you and Dave Skarica were talking about gold and gold stocks. Basically, what you and Dave found was we're looking at a huge buying opportunity here, but nobody is buying. The operative word here seems to be fear. What the heck is going on?
Well, that's right. And, I've actually, it's been 10 years, I've been trading gold stocks, but really in the past 2 years, I have barely done anything with them. And I'm just now getting back into buying gold stocks. But my thinking is it's time to buy it with the plan of really investing in them and holding them for a long time. I really believe that we're seeing an opportunity now that only comes around every couple of years in them. And, I'll talk about the negative aspect of it first, where people seem to be very scared of them and worried. Gold stocks have been correcting since last September, and they basically, even before that, really haven't been going anywhere. They've been in a sideways pattern for almost a year and a half now. And what tends to happen is during corrections that last that long, or even if a market's not going up, people lose patience and they get angry and they start selling. And once they sell, they decide, well, it's bad, I'm now bearish, and so forth. And that's really what's happening. And as proof of that, I've got a large email list, and talk about these gold stocks on it, and the feedback I get from people in emails are they're very, very nervous, and they give me reasons. I get more emails where people are saying they're going to drop than where people think they're going to go up, and they and then when someone does say they're buying too, they'll say something like, I'm buying, but I'm scared. I'm just going to buy a little bit.
Now, everybody likes to ride a winner. I mean, you look at the hard numbers here, the GLD, that's the $67 billion gold ETF. That's up 5% year to date. But the GDX and the GDXJ, the senior and junior miners ETFs, they're down almost 10%. That's got to affect investor psychology. But is it the right kind of psychology to have at this point?
Well, no. I mean, generally speaking, you don't want to be in something when everyone in the world is bullish on it. I think about internet stocks back in 2000, and the best time to buy is when everyone is terrified and bearish and scared, because that means there's not really that many people in the market, and those people eventually will change their mind and start buying. I would contend that, a lot of the email subscribers I have, they come from gold websites. They're people interested in gold, and then they're too scared to do anything now. Well, if gold starts to go up and these gold stocks start to go up like I believe they will over the next year or two, well, these people will buy in the future. But they're too scared to take advantage of low prices now. And I want to, give more of an argument of why I think this is the time to be buying. But one thing about these movements where you said, gold is up a couple percent and then the gold stocks are down 10%, and like you're saying, that's really disturbing to a lot of people. But what people have to do is put this in context of the past couple of years. And we saw a horrible crash in 2008, and the HUI fell down to about 150. And after that, it went up 400%. Well, any market that goes up 400% tends to have to digest those gains, and that's what gold stocks basically been doing for the past year and a half. They're going sideways and digesting that 400% gain. And if you look, for the past 10 years, there's been several times, about 3 of them before 2008, where that's what gold stocks did. They went sideways after basically doubling. This time they went up 400%. So I think that's what is going on right now. People are grasping for explanations for why they're not going up, and I think that's, the simple explanation.
One of my favorite themes that we've been talking about over the last year or so is the disconnect between gold prices and gold equities, and I'd like to hear your take on that.
Well, I think what I've said is kind of the reason why that disconnect is there. If you look back to 2008, the gold stocks completely crashed. The HUI fell from like 550 down to 150, and it had to go up almost 400% to take back all those losses, and it did that. Well, in 2008, the price of gold didn't fall as much as the stocks did. And then between 2009 and 2010, the stocks actually, for most of those 2 years, went up at a faster rate than gold did, because it had to catch up with its giant drop. And since then, the stocks are basically digesting that gain, and they're not performing as well as gold is doing. But I actually think that's going to change at some point. Probably, I think towards the end of this year or next year, it may be very substantial. On the next, let me put you this way, since 2002, we're in this secular bull market in gold and gold stocks, and we've seen basically 4 big moves up, one in 2002, 2003, 2005, another one in 2007. And these are new moves higher. And then, of course, this after 2008, there was one. But I think we're going to see another one, and it'll be at that point that the gold stocks reassert that leadership of outperforming the metal.
Mike, one of the new things we're watching, the miners sitting on a ton of cash. Companies that are not acquiring other companies are increasing dividend payouts. You say that almost all of the stocks you're buying, mining stocks, are paying dividends upwards of 2%. Is that a fairly new trend?
It is, from what I've seen. I mean, I've been buying these, or looking and trading these stocks for 10 years, and most of that time, most of them don't pay any dividends at all. And they started paying dividends a couple years ago. But what's happened is the stocks they've increased their dividends while the stocks haven't gone up, or they've in fact dropped. So now we're at the point where a lot of these stocks are paying 2% dividends, in some cases 3% dividends. And I'm speaking of the majors that trade in the United States, Newmont, Barrick, Agnico Eagle, and so forth. And not only are they paying dividends, but what's really unusual and attention-grabbing to me is that they have very low valuations if you look at the fundamentals and the earnings. Almost every one of these stocks has forward Ps of less than 10. They have PEG ratios under 0.5, and what the PEG ratio does, it's like a forward PE, but for 5 years out.
Okay.
And typically, a growth stock, if the PEG ratio is 1, is fully valued. So when you're looking at a stock with a PEG ratio less than 0.5, it means that it would have to at least double to become fully valued. And in fact, some of the stocks even got ones half of that. So like Newmont's got one, I think it's below 0.3. These aren't just little junior mining stocks.
Mm-hmm.
These are the biggest mining companies in the world. That, in my view of things, to become at the right correct valuation, or should be 2 or 3 times what they're priced at now.
We're talking to Mike Swanson from Wall Street Window here on This Week in Money. And here's a quote, Mike, from Brian Hinchcliffe. He's from Kirkland Lake Gold. It's a $1 billion miner, so it's a big company. And Brian says miners should pay more in dividends if they're going to compete with ETFs. He figures a dividend policy of around 5 to 8% is the best defense against ETFs. Now, when you look at the companies on the Huey, they're paying an average of around a 1.5% this year. There's a huge distance between 1.5 and 5 and 8%, is there not?
Oh, yeah. I mean, to pay a 5 or 8% dividend, that would be pretty incredible. I mean, it's especially nowadays when you have the Treasury bonds are yielding almost nothing.
Mm-hmm.
You know, to pay 5 or 8% would be an amazing thing for a mining company to be able to achieve that.
Yeah, I'm wondering if that's sustainable, and really, is that the best reason to be buying a stock?
Well, in my view, the way I invest, I don't really necessarily seek out dividend stocks. I see a dividend as a bonus.
Okay.
I would like to invest in what I think are the best sectors of the market on a technical view and also a fundamental basis. And in both those cases, I actually do think the gold stocks stand out. And the dividend is like a nice bonus to be rewarded for getting into it. But it's share appreciation that I think is the key. And here, in my view, you have gold stocks which are in this very long sideways consolidation phase, which I think will likely end by the end of this year or next year, which would mean once it's over, we'll get another big leg up in the secular bull market. But more importantly, I think now is actually a great time to buy ahead of that consolidation phase ending, because the stocks have been correcting since September. They're very oversold on long-term technical indicators. And then, like I mentioned before, on a fundamental basis, they're extremely, extremely cheap. And it's very difficult, in fact, to find any sector in the stock market that's priced as a whole as cheap as gold stocks are right now. And that's a rare occurrence. I mean, these gold stocks can get to high valuations. They've done it in the past, several times. Before they crashed in 2008, they had gotten to one. And I think they're going to do it again in the next couple of years. From here to high valuation, I mean, that would be a great ride. I think, it can take some time to get there, but once it starts to happen, people who get in now, will be able to look back to today sometime in the future and see that the rewards could be financially much bigger than anyone can imagine they would be now, especially when you've seen them not go up for so long. It's hard to imagine them going up for most people, but it'll happen.
Mike, a couple of weeks back, you talked to our good friend David Morgan, and he gave some great advice. I thought this was perfect and well worth repeating. He said, don't load up now, space out your buying, build a position, and for God's sake, keep a long-term horizon.
Well, I agree with that, too. Even though I'm saying now is a great time to buy, well, I'll just tell you what I'm doing personally.
Okay.
I've not been in gold stocks for quite some time, or silver stocks either. When I talk about gold stocks, I really also mean them, too. But what I've done is I took a position last week, and I plan on investing in this position and holding on to it for several years. However, I also have money that I have sitting there, not in use, that I plan to also add to this position or buy more different mining stocks. And I plan on doing that later in the year. So if the stocks go down more somehow, I'll have money available to average in at a lower price. And if they don't, and it looks like they're going to break out after they've based out and go sideways, then I'll be in a position to add on then. So either way, my thinking is that, in a year or next year or the end of this year, we'll start to see the gold stocks march and break out to new highs and start another leg up. And I want to average in before that happens by buying at this level and hopefully, slightly higher levels later, but somewhere before the year is over.
Mike Swanson is founder and chief editor of Wall Street Window. He publishes a premium trading service. It's called Wall Street Window Power Investor. And you can find Mike online at wallstreetwindow.com. Hey, Mike, thanks for this.
Yeah, thank you. It's real fun.
After the break, Ben Jones on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
Ben Jones publishes the Housing Bubble blog. He is based in sunny Arizona, and he's online at thehousingbubbleblog.com. Ben, welcome to This Week in Money.
Thanks for having me.
For our friends who have not met you yet, Ben, tell us a bit about yourself and the Housing Bubble blog.
Well, I started this blog in 2004, late 2004. I was concerned about the markets, and truthfully, I wasn't convinced that there was a housing bubble. I just had an idea, and it was sort of a talking out loud thing, and it was a free blog on Blogspot at the time, and a few people started coming, and it grew word of mouth, I guess, and I did some newspaper interviews and such, and it really took off. I guess I wasn't the only one worried about it.
Ben, one of the things I like about your blog is you avoid a lot of the real estate spin we're used to, that most of the comments you're getting are from people around the world who give great anecdotal evidence of what's happening in their particular market without the spin.
Right. Well, reading between the lines was a big part of seeing the bubble, I guess you could say. A lot of it was anecdotal. I might find articles where people were making some pretty outlandish claims, or boosterism, from the industry itself, and that was, that's the kind of stuff that actually people value the most, because ordinary, everyday folks, they can see baloney when they read it, and seeing through the spin, I guess there's a way to put it, but it was actually indicative of the mania that was going on at the time, and it's still going on, in my opinion, because bubbles or manias, that you require all kinds of justification, and so people do that after the fact. In other words, no one really predicted that prices would go where they would in California, but they sure explained it away, and did so tirelessly.
Ben, let's talk about the Canadian real estate market. Here's a huge bubble, and you're saying it's overdue for a correction, just like the U.S. experienced about 4 years ago. Give us your view of what's happening in Canada and how you see this correction unfolding.
Well, I don't think it's possible to get the timing exactly right, but I think that once there is a bubble, it has to collapse. I think that history's proven that. I was posting in I believe like 2005, at least through 2007, about a little correction that Australia was having, and then it took back off again. And I think that was because of your government policies, interest rate policies, lending policies. But, at the same time, bubbles are basically psychology-based. They're not based on fundamentals by definition. So it's not hard to talk people into being greedy, and I think that that's why, what accompanies manias is lots of speculation, and I think there's certainly a lot of speculation there, especially by folks from outside of Canada, just like the Canadians are coming down to Arizona now.
Let's talk for a second about what's happening here. We have just received some news from the Bank of Canada saying it's thinking about hiking interest rates again. The bank says our debt here in Canada is at record levels, and it points the finger at house prices and real estate investment also. And here's a scary number here, Ben. The Bank of Canada says the tremendous growth in home equity lines of credit is part of the problem. Here's the HELOC market, 8 times bigger than it was 10 years ago in Canada.
Right, and that's, at least in a housing bubble, maybe a little bit different from a stock bubble. It's debt-based, and they're, credit markets fuel them or put them out, basically, in central banks. And we're hearing and reading quite a bit down here that there's Canadians that are coming down and they're getting loans for 70 or 80% of the properties they're buying, and then using their Canadian HELOC money to make the down payment to basically be 100% leveraged. And they're actually quite proud of that whenever I read about it.
Canadians, of course, according to the Inman News people, are the most popular buyers in the number of markets in the U.S. Listen to some of these stats here, Ben. Phoenix, 90% of home buyers Canadians. Sarasota, Tampa, Miami, greater than 75% of home buyers are Canadians. What's that doing to the U.S. market, and should we be concerned?
Well, I see it directly because I have a fund that buying foreclosures, and whenever I put in offers, and I'll hear from the realtors, well, this thing's going to be gone the first day it's on the market, and it will be. And sometimes they're paying above asking. I think that they're besides paying too much, the cumulative effect of so much money rushing this market is actually causing prices to go up a tad, and certainly not fall where they should be. On top of that, I don't think these folks are doing their due diligence. What I'm seeing is professional bidders doing this work, bidding for them. They're buying a lot of houses sight unseen at trustee sales, which, the courthouse steps sort of auction.
Mm-hmm.
And I think, that's basically very similar to the run-up that we had here in the United States. I think it'll have this interest. I've pointed out before that what this looks a lot like to me is when Californians, for instance, got the fever and were going into Vegas and Nevada back in 2002, 3, and 4, using home equity money to buy speculative properties here. I think it's pretty much the exact same effect, a rolling bubble effect, what we call it. And I think that the Chinese buyers that you're seeing in Toronto and Vancouver are a similar phenomenon. Yeah, that Inman News, that's scary stuff, but it sure backs up what I'm seeing on the ground.
Yeah.
It was really it changed kind of slowly, but then it just picked up. And it's not just Canadians. It's Australians, people from New Zealand, and anecdotally, I've even read about people in China. But I did see a stat the other day that Chinese are buying quite a bit in Florida. And I do read also that Canadians are buying quite a bit in California, which is, California prices are probably 2, 3 times Arizona. I can see why people look at a house and they think, well, that's a $50,000 house. Can't go wrong on that. But they need to look at what that house sold for, 15 years ago, and they may have Another thing that people don't really realize is a lot of the construction in Arizona was in these drive till you qualify communities. And I don't think anybody knows what that stuff's worth because those subdivisions wouldn't even be there if it wasn't for the housing bubble.
Yeah.
So, folks they need to be aware that this market's not exactly what it ought to be.
Let's talk about the Chinese market for a second. It's the biggest housing market in the world, and there's all kinds of trouble coming out of there. What do you see happening in China, and how's that going to affect real estate here in Canada and also in the U.S.?
Well, I think that those folks that are buying pre-construction condominiums in Vancouver and Toronto, for instance, they're not going to be there to close when those condos are finished. That's what we saw in Miami, for instance, quite a bit. A lot of towers that were started, and they didn't have buyers when they finished them. And that was pretty devastating. I think it's pretty clear that China has the largest housing bubble in the world right now. And, again, the timing on it busting is pretty hard to see. But like I said before, once there's a bubble, it has to pop.
More with Ben Jones next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, mollycore.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're talking to Ben Jones from the Housing Bubble blog. He is at thehousingbubbleblog.com. And I guess one thing we need to know at this point is if I am a Canadian investing in real estate in Canada, what should I be thinking about going forward? And let's confine ourselves to Canada, and then we'll talk about the U.S. in a second. But for Canadian real estate investors, what should I be careful of going forward?
Oh, well, if I wouldn't buy anything in Canada right now. I think the prices are clearly insane. And I think a lot of people are getting themselves up to their neck in debt, and it's going to be ugly, in my opinion, just like it was here in the States, and still is here in the States. I mean, we're still mired in a pretty bad recession, and that's one of the reasons why you're seeing so many Canadian buyers here is because Arizonans don't have the credit to buy very many houses.
Okay, now what kind of advice would you give to Canadians buying American real estate?
Well, they need to do, I think, better due diligence. Buying this stuff at the courthouse steps doesn't make a lot of sense to me because if they're in this pre-foreclosure, you can't go inside the house. They're buying it sight unseen. But the main thing is don't pay too much and be aware that the effect that all of this outside money is having on prices. And one thing that's really hard for most people to get their head around is this shadow inventory. These markets are being manipulated down here quite a bit. The lenders are holding, for instance, I was told in one zip code that there was less than a 1 month supply of foreclosures. In the very next sentence, I was told that this brokerage was holding 150 houses off the market, waiting to put them on. So what they're doing is they'll sell 10 houses, take 10 houses off the shelf, put them back on the market, and sell them again. Mm-hmm. And that's legal, and it's understandable what the lenders are doing. They're trying to get top dollar. But the buyers need to and deserve to know that, too. And, I think property foreclosures should be distressed sales, not some kind of fire sale. Yeah. I mean, rather, they should be a fire sale rather than these things being bought in a single day or in the morning that they're put on the market. And I think if Canadians could just be aware of what's going on and be a little more discerning about price. For instance, I think that the values, you'll hear that they'll say, well, this is down to 2003 value. This is half of what it sold for in 2006. I think that's irrelevant. How much it did sell at one point, that doesn't mean anything. But if you were looking for a benchmark, I would look back to 1996, 1995 prices for what the true value of these properties are.
We're talking to Ben Jones here on This Week in Money. We're talking about housing. And Ben, one of the things that you have mentioned a number of times is that every time you hear people talking about the housing bubble as if it's over, it just makes you go cold.
Well, yeah, it's the powers that be, however you want to describe them, a lot of them being experts that couldn't see the bubble in the first place, were really eager to jump past the topic and talk about it in the past tense as if it was over. I think the prices are still way out of line with incomes, which is the best way to know that there's a bubble, way out of line with incomes in many parts of even Arizona, but especially California, the East Coast, like Massachusetts, New York, and even, places like Illinois, really all over the country. This was a global bubble, and prices are out of line with incomes in, for instance, Beijing, probably more than any other city that I've read about. So this was a global bubble. It's not done. Canada's indicative of that. Australia's indicative of that. So is China, other places. Sure, it's down, but I think it's not over by a long shot.
Ben Jones from the Housing Bubble blog, our guest here on This Week in Money. And Ben, tell me the difference between recourse and non-recourse. That's something we should try and understand here.
Well, Arizona's got, every state has its own rules, but it's whether or not the banks can come after you post foreclosure. In other words, whether you still owe them the money. For instance, in California, and this is the way I understand it, I'm not an attorney, but a regular house loan primary home loan is without recourse. But if you take out a HELOC, if you refinance, it is recourse.
Okay.
And I do read about people being pursued sometimes years later for the balance that they owe, and they're selling it to those credit collection people, that chase you down for maybe an old bill or a credit card balance, and those folks just don't let go. So, yeah, people need to be aware of that. I don't know if that's the case up in Canada or not.
Ben Jones publishes the Housing Bubble blog. He's based in Arizona, and he's online at thehousingbubbleblog.com. Ben, appreciate you talking to us today.
Oh, thanks for having me.
Thanks to our guests, Rick Rule, Mike Swanson, and Ben Jones. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.